Financial markets are reeling from the aftermath of 3 U.S. banks collapsing. Is this a sign of a larger economic crisis? Hello, I'm Anand Naidu, and this is The Heat. In less than a week, U.S. Silicon Valley Bank and Signature Bank folded, sending shockwaves through international markets. Sparked by a social media frenzy, customers made a run on both institutions with $42 billion withdrawn from SVB in just one day. Meanwhile, the U.S. Department of Justice has begun an investigation into what happened. We begin with this report from CGTN's Owen Fairclough.
Silicon Valley Bank customers at the center of one of the biggest runs on deposits in history.
Quite nerve-wracking.
Met with reassuring words from federal regulators who've taken it over.
So you will be able to transact business as usual. Your accounts are safe. Your online portals are active. You'll be able to wire and do business as usual.
The US government is giving the same protection to customers of the New York-based Signature Bank.
This is something I did not expect.
Both collapsed in recent days after customers worried about the bank's solvency began withdrawing their money by the billions until the government stepped in to guarantee their deposits.
The banking system is safe.
President Biden trying to soothe financial markets after bank stocks plummeted amid fears SVB and Signature would create a domino effect. The US Central Bank, the Federal Reserve, is also trying to calm the storm by setting up an emergency lending fund for any banks suffering liquidity problems, effectively backstopping the entire financial sector with its huge reserves.
The Fed learned the lessons of the 2008 global financial disaster when it had to step in to save the entire banking sector with no real playbook. So this time it acted decisively to stop contagion spreading too fast and too quickly. But the collapse of these two banks now presents the Fed with a fresh headache over how to tackle the highest inflation for years.
SVB collapsed partly because it made huge investments in long-term bonds and treasuries that typically rise in value when interest rates are low, as they had been for the best part of 15 years. But when inflation spiraled out of control, the Fed began raising that benchmark interest rate that in turn influences the rate banks and other lenders offer.
The value of those long-term bonds and treasuries dropped as interest rates rose. And quickly, SVB found it was suffering huge losses and then trying to cover those customer deposits. So this crisis stems in part from the Fed aggressively raising that benchmark interest rate over the past year or so to try to drive down inflation, leaving some banks brutally exposed.
Just last week, Fed Chair Jerome Powell told lawmakers he planned to keep raising those rates.
The ultimate level of interest rates is likely to be higher than previously anticipated,
especially as the latest data out this Tuesday shows annual inflation at 6%. That's 3 times higher than the Fed's target of around 2%. So many experts now say the SVB and Signature collapse means the Fed will halt that interest rate trajectory at its next meeting, even as inflation remains stubbornly high. Owen Fairclough, CGTN, Washington.
To discuss this and more, let's bring in our guests. Joining us from Silicon Valley, California, Wang is the founder, chairman, and principal analyst of Silicon Valley-based Constellation Research Incorporated. Here in Washington, D.C., Brian Becker is the executive director of the Answer Coalition. From Los Angeles, we're joined by Ryan Patel. He is the global business executive and senior fellow with the Drucker School of Management at Claremont Graduate University. And from New York, we're joined by William Cohan, who is an American business writer and founding partner of Puck, a daily digital news and opinion publication. Welcome to all of you. William Cohan, of course, the banks that we are talking about, Silicon Valley Bank, known as SVB, and Signature Bank. There's also problems at Silvergate Capital. I mean, we are hearing words like contagion, collapse, failure. What, in your view, are the underlying conditions that led to this? Is it just about interest rates and treasuries, or is there more to it?
Well, there's always more to it. It's never just one thing or another. You had the combination of a very dramatic loss in confidence in Silicon Valley Bank, combined, so that leading all sorts of the customers of the bank to, as you said, withdraw deposits of more than $40 billion very rapidly at the end of last week, and then to try to satisfy that demand for that cash, because as you know, in a fractional banking system, the cash is never at the bank. Our deposits aren't at the bank because the bank needs them to lend out to make money using the spread between what they pay us and what they can get on the loans that they make as their profit. Since the money was not at the bank and people wanted it so rapidly, they decided to sell some of their long-term bonds that they had invested in when the bond market was at its peak. And they discovered, unfortunately, that those bonds had lost value, a lot of value, something like nearly $2 billion in value, and they had to perfect that loss. And then when they tried to do an equity raise simultaneously to replace that lost value, that didn't happen because of a variety of circumstances led by potential debt downgrade by Moody's. And so the combination of all of that led to the failure of the bank.
William, it sent tremors through the markets, but if we look at the stock market on Wednesday today, stocks fell very sharply in early trading, but they rallied by the time the stock markets closed. What does that tell us?
It tells us that investors are very uncertain and there's a lot of volatility, and we're not really sure where this is going to end up. This is sort of, you know, a little bit of uncharted territory. We've seen plenty of bank failures, but you know, the rapidity of the failure of Silicon Valley Bank, as well as Signature Bank, you know, I think stunned markets. But I think the Fed and the Treasury and the FDIC did the right thing by saying they would lift the limits on depositors' guarantees beyond $250,000, and that has calmed markets somewhat. But you know, we just don't know how it's going to play out, and so you get market jitters. The markets go up like they did on Tuesday, and then they fall Wednesday, and then come back a little bit as people try to figure out what's really going on here.
Ray Wang, you're in Silicon Valley, and let's look at the bank, SVB, Silicon Valley Bank. It was a tech bank financing startups, and it sent shockwaves through the tech sector. What's it like in Silicon Valley? I mean, is there a lot of anxiety?
There is still a lot of anxiety. I think it's the first time a lot of founders have gone through this situation where your bank collapsed. Silicon Valley Bank was a pillar of the community. They gave out loans to individuals in the tech and the biotech space. High tech and biotech were beneficiaries, and there were partners all across the board. The challenge here was just a run in confidence, right? And there are a couple factors, as you know, right? It's really the hike in interest rates, some mismanagement by the bank, and of course the Federal Reserve not doing their job in terms of flagging this as an issue earlier. And those three things would set off a firestorm, especially in the social media world. I mean, in 48 hours, I mean, you can shut down a bank in social media because every founder is running worried. Every VC is actually telling their clients to take their money out of the bank. And that process is still happening with some of the other regional banks as everybody's moving to too big to fail banks at the moment. Chase, Citi, Wells, and B of A.
That's right. I think CNN called it a Twitter-fueled frenzy. But Ray, does it in any way place something of a question mark over venture capital availability?
It definitely does. I mean, if you look at what happened really in 2021, there was something like 1,035 IPOs, right? And in 2022, that number went to 151. And that dearth of capital was really the issue that's going on here. And it's a question of really what's going to happen into the startup scene and what happens as people continue to preserve cash.
Brian Becker, President Biden was quick to take to the podium and reassure investors that they weren't losing any money, that they were covered. And he said, as we heard in our report, that the banking system is safe. Everybody's fully covered. But what does this tell us? Because, I mean, we had, of course, the case in 2007, 2008, which led to the Great Recession. But what about congressional and regulatory oversight of banks? What's happened?
Right. I mean, we should just recognize that President Biden doesn't actually know himself whether the banking system is safe or not. So he's like the doctor coming out and telling a family that has a severely ill person, perhaps someone who's maybe dying, that don't worry, it's all fine, just trying to smooth everyone's nerves. I mean, that's what President Biden's comments were. We have today Credit Suisse, basically in the same state as Silicon Valley Bank, except its assets are twice as large. That's the second largest Swiss bank. The interconnectedness of the global economy and of international finance, that's such that the contagion actually can grow very, very quickly. And it's not simply a problem of psychology or a run on the bank or panic, even though all of those psychological, emotional elements are present. I mean, 90 years ago in 1933, in the middle of the Great Depression, the banking system basically failed. Earlier in 1907, the banking system failed. That's how we got the Federal Reserve a few years later. And we've had 4 major economic crises in the last 20 years, just since the turn of the century. We give it the name .com, or the housing mortgage crisis, or then the COVID pandemic, and now perhaps a 4th one, if it is indeed a 4th one. We can hope that it's not. But you can give it different names, but we have a sick system where all of the bankers are never held accountable for gambling with other people's money. It's a big racket. It's a casino. I mean, during the savings and loan crisis of the late 1980s, when about 20% of all of the savings and loan banks crashed, there were thousands of criminal referrals to the Justice Department. In 2008 and 2009, when the U.S. government spent trillions to bail these bankers out, let a few fail, but basically bailed the rest of them out. No accountability, no criminal referrals. And so we're going to do it again and again and again. And the American people, like say in 2008 and 9 million families went into foreclosure. 3 million lost their homes. Tens of millions lost their jobs. I mean, this is a great price being paid by society as a whole, and the people who aren't bankers, and yet the bankers, we're always told, are too big to fail, and so the U.S. government's going to rescue. I mean, it's a sick system.
Brian, you say it's gambling with other people's money. I mean, whose fault is this?
Well, I think it's baked into the fabric of the current system. I mean, you know, the banking system, the role of finance and finance capital in modern economies doesn't have to be this way. And there doesn't have to be one way to fight inflation. You know, in August 1971, when there was a lot of inflation because of Vietnam War spending, deficit spending from the war, and again, deficit spending for war is a big factor in the American economy, President Nixon signed a price freeze instead of raising interest rates over and over and over with the intent of sinking the economy, which is what the Federal Reserve is doing right now. There are other measures. You have the abandonment of the Glass-Steagall Act, which was again passed in the 1930s when the banks collapsed. That was gotten rid of in 1999 during the Clinton administration. So all of the system is geared towards making maximum profits for bankers, and the rest of the society is left to pick up the tab.
Ryan Patel, what do you make of what's happened? I mean, and how different is what we're seeing now from, say, what happened in 2007, 2008?
Well, there's a difference between the recession in the economy based on, I think this is obviously mismanagement and leadership. I think there's also this aspect of, you know, the backing and the stepping in of governments and also the economy, different sectors too, are not being affected when you think about 2007, 2008 as the bubble is building. Now, what is also different, which we have to talk about, is that social media and the way that we communicate and how much more we're interconnected could have potentially bigger impact, actually, should this go down the route that you couldn't stop this. And that's why you see and you saw the U.S. government and FDIC jump in so quickly. And I think even when we see the news out of Europe and the Swiss, you know, the central bank banking and making sure that other banks are solvent, these aspects, I think, is the learnings from 07, 08. And I think that's what we're going to see what's different from now than before.
Do you think, Ryan, that we're out of the danger zone now, or, I mean, has the bleeding been staunched?
Okay, Anand, that's a loaded question. And you know what I'm going to tell you is that this is just the start of this conversation. Just because the Silicon Valley Bank could be resolved, will we see other potential banks, you know, have this issue? Quite frankly, because guess what? more people are paying attention to people's assets now, are getting looked at further. Regulatory pressures are looking at it. And I think the other thing behind this too is I think the Wall Street, the ups and downs that we've seen from Monday, Tuesday, Wednesday, unfortunately, Anand, that's not going anywhere because people are on pins and needles still. They still will be this time from a month ago because inflation's still there and there's still this credibility and credit issues with the bank. So even if we think in 2 weeks we're fine, it's not completely fine until you have some time to go by. And I think this conversation, unfortunately, is going to raise tough questions from consumers, governments, and business and startup community on where and what I do with my money.
William and Cohan, we heard several references there to the Swiss bank, Credit Suisse. What's the connection? Why did Credit Suisse get affected by what's going on here?
Well, Credit Suisse, even though it's more than 150 years old and was once one of the pillars of Wall Street when it was called, when a subsidiary was called First Boston, was highly respected on Wall Street, was a highly effective bank. This bank has been slowly going down the tubes for 5 or 6 years now, lurching from one crisis to another, and its stock price has been slowly sinking right before our eyes, and management turmoil has been legendary. So I don't really see this as necessarily connected in any way to what's going on with either Silicon Valley Bank or Signature Bank. I think Credit Suisse has its own problems, and I think they're just sort of coming to a head right now as they're in the middle of trying to effect this major restructuring that they've announced a few months ago. And as their stock price continues to sink, I think investors just are like starting to throw in the towel, and either they're going to go bankrupt or they're going to be rescued by the Swiss government.
In fact, the Swiss National Bank has said that it will offer help to Credit Suisse if that is necessary. William, I'd also like to get on your view on what Brian was telling us a moment ago about the fact that this happens repeatedly. He mentioned 4 circumstances. Why does it happen so often?
Well, I mean, I do agree with Brian that this happens a lot. I think, unfortunately, it's by design. It's the nature of a fractional banking system. It's the design of the system. And as a country, we have decided, and maybe perhaps as a capitalist world, we've decided that this kind of crises are acceptable every 10 to 15 to 20 years, because that's basically how often they've been happening. And, we sort of deal with it every time that it happens as best that we can. And there's a lot of pain along the way, but then there's, 10 or 15 good years when everybody's happy with the banks and everybody's getting all the capital they want and they're all making lots of money and it's a big party. But in a fractional banking system, we put our deposits in the bank, but the deposits are not there. The money is not there. If the money were there, the bank couldn't make any money, couldn't make profits, and they're in business to make profits. So they have to lend the money out. They have to invest the money. They have to take risks, and it all works great as long as everybody doesn't freak out and want their money at the same time. But when they do, you almost can't stop it. And in this age of social media, where you've got a device in your hand that lets you transfer money instantly and communicate instantly, the rumors start like wildfire. And in this case, in Silicon Valley Bank, people, decided to take out $45 billion in one day. And so there's no stopping that in a fractional banking system.
Ray Wang, looking again at what's been going on in Silicon Valley, a columnist at the Financial Times, Robert Armstrong, he wrote an opinion piece in that newspaper, and he said this, and I'm quoting him here. He said, SVB was an outlier in the banking industry in 3 ways. Its deposits were unusually sensitive to interest rates, its assets were unusually insensitive, and its client base was unique. What are your thoughts on that assessment?
Oh, it was definitely a very unique customer base. I mean, these were the founders. Founders were told that if you had operating loans from SVB, you had to actually bank with them. And they did. They gave them favorable rates. If you wanted to buy a home, you wanted to buy a boat, you wanted to buy a jet, they made it very easy for them. And so it was a very insular base, but a very, very high net worth concentrated base. And in return, what they would do is try to go out and make money off of those numbers. And they actually did pretty well in general. The challenge was not that. The challenge was this long-term bet that was going on long-term rates when the market was continuing to increase rates and not getting that right. That's the management aspect. But this is a problem across many U.S. banks. If you look at it, just 1 year ago, the number of losses on available for sale and held to maturity securities was 8 billion. That number at the end of February was 620 billion. So this is much bigger than people realize. It's happening everywhere. And I think people have to be more aware into that transparent aspect. Now, for the Valley, though, this is going to be very tough because if you're a high-tech entrepreneur, if you're a biotech entrepreneur, no one understands that business better, that you're going to be losing money for quite some time. But at some point, when you hit escape velocity, you'll actually make it. And that's what Silicon Valley Bank was really good at, was betting on those winners and betting on those founders.
Brian Becker, there are many, including some on Wall Street, who blame the Federal Reserve and the rise in interest rates for the collapse of these banks. The Party for Socialism and Liberation tweeted, you're one of the founders, tweeted, quoting here again, the Federal Reserve has been raising interest rates because their solution to the inflation crisis was to crash the economy, but they hoped to keep it in a controlled burn that would play out with mass layoffs. But not many major banks or companies are going under. So tell us more about that.
Yeah, well, you could see that. And you have Jerome Powell, not to mention the Wall Street commentators, the Wall Street editorial board, Financial Times editorial board, where they clearly saw that the route to curb inflation was to, quote, cool the economy. Well, what does cool the economy mean? It means to basically create an investment environment such that it's unprofitable to take out loans and to invest those loans. And that means that there will be ultimately layoffs. And there have been lots of layoffs, by the way, in the tech sector in particular. And of course, Silicon Valley Bank was serving the tech community, the tech venture capital and major tech companies. So Jerome Powell and the Federal Reserve are trying to basically cool the economy, which means to bring the economy to a lower level. And what does that mean? It means millions of people either losing their jobs or losing some of their jobs. Many workers are now working 2 and 3 jobs. They can't survive just by one job. So the solution for the Fed was, we'll chill the economy, we'll make it a slow growth or negative growth. That will mean a deflationary impact as opposed to the inflationary impact when demand is high. So by reducing demand, by increasing interest rates, it basically says to one part of society, mainly the working class, the middle class, and the poor, you guys are going to pay the burden of this coming economic downturn. And they expected, and this is what the point of that tweet was, they expected that the banks would be immune. The already very rich and very privileged would continue to be very rich and very privileged.
Right, Brian.
And that's not always what's going to happen.
Yeah, Brian, there are these, of course, efforts to cool the economy, to get inflation down. But then again, if we look at the employment numbers, they're pretty good.
Well, Jerome Powell also said something else, which I think is really important, because we're talking about why is there a labor shortage? Why are so many, people still, why are there so many job openings? According to Jerome Powell, 500,000 workers died during COVID. There was 1.1 million Americans who died. 500,000 were left the workforce. A lot of other older workers also said, it's not worth it. I don't want to get sick. I don't want to die. I don't want to take the chance with COVID. So they left the workforce. So we have a labor shortage, but it's not because the economy is sizzling. There were also failures in health policy that created this situation.
Ryan, MarketWatch, which is a big financial site, reported that there are 20 other banks sitting on huge potential securities losses, huge bond losses, and at least 10 are bankruptcy applicants. What do we know about that? I mean, is this just under the radar right now?
I think it'll be interesting to see. I think the easiest thing is that people like to compare it to the Silicon Valley Bank thing, and I think each bank has its own history or transaction aspect. Right? Silicon Valley Bank had a large amount of deposits made in 2021. I think it was the largest in its history. And so when you invest that kind of money into these long-term bonds, you put yourself up to failure for what just happened. I think what would be interesting to see what assets they have, what kind of exposure they have in each of these. But yes, like I mentioned earlier, this is where every bank is going to be, I don't want to say scrutinized, but they're going to be reevaluating the decisions making that they made. What kind of risk did you put under that leadership, right, to be able to do that? Because I think that is the strategy that most of these folks don't know. And I think one of the silver lining out of this, Anand, too, is that the consumers got smarter over the last 4 or 5 days. I can't tell you how many people were asking, well, is this the process of how my money is being used? So people are looking, at what does financial literacy mean? What banks are doing? What should I be asking questions? And I know it's a macro, micro kind of thing, but I think at the end of the day, if we're all smarter and we all know what is going on with where you put your money and who you want to bank with, I think your question becomes, it gets into the right place with the right leadership.
William Cohan, I've only got about a minute left, but where do you see this going in the coming days, coming weeks? I mean, we've seen interest rate rises, we've seen the consequence of that, but what else can be done to calm waters?
Well, I don't think we've yet seen the full effect of the Fed's 13-year zero interest rate policy. That's a long stretch of time to reduce interest rates to the lowest level in recorded history. And I think the Silicon Valley Bank disaster, Signature Bank, these are some of the unintended consequences of keeping interest rates low for that long. I wrote a book about the collapse of Bear Stearns, and everybody thought in March of 2008, literally 15 years ago from today, that the crisis was stemmed. And it took another 6 months before we found out that the real crisis was just unfolding. So too soon to say.
Okay, and we need to leave it there. Thanks to all of you for being with us on the show. I'm Anand Naidu in Washington, D.C. Thanks for watching.
The nature of business is to bring value. Business activities in Europe, Asia, and the U.S. reach consumers globally. Trade, manufacturing, energy, high-tech, real estate, consumption.